Hi there. Suppose you were the owner of a small bakery store and you wanted to sell it for $10. Being a potential buyer, how would I know whether it's really worth my while? Although it was as cheap as $10, I wouldn't go for the deal if it was a loss-making business. No one pays to lose money. That's when valuation ratios come in handy. This is another set of indicators that help us measure the value of a company and its common equity in particular. Most valuation ratios indicate the intrinsic value per one common share of a firm's outstanding stock. Thus, you can compare a share's price, at which it is currently trading, to its value and determine whether common equity is under or overvalued. All right, let's take it one step at a time. Investors are primarily interested in the earnings per share, EPS, metric. It tells them how much income a company earns per one common share. It is calculated as net income divided by the outstanding number of common shares. A word of caution. Here we take the outstanding weighted average number and net income related to common stock only. That's why, in the presence of dividends paid on preferred stock, they should be excluded from the net income figure. Also, in the denominator, we need the weighted average number of common shares outstanding during the year. Suppose that SalesSmart has issued 10 billion common shares to the general public at the end of last year. We say that it has gone through an initial public offering or an IPO. It hasn't issued any preferred shares, so there are no preferred dividends paid. Okay. So we can easily calculate its earnings per share by dividing the net income of $17,698 million by 10,000 million common shares. This makes $1.77 EPS in the current year. Similarly, we obtain $1.40 earnings per share in the previous accounting period. It seems that SalesSmart's EPS measure is increasing, which is a very good sign to investors. In this case, note that the number of shares outstanding does not change. Potentially, whenever a company raises additional capital, the number of shares will go up, right? Thereafter, EPS would drop. So any decline in the EPS indicator should be looked at with a grain of salt. It is not necessarily due to lower net income. It may be an indication of an increased capital base and potential future profitability. The same remark is valid for other per-share ratios. Besides earnings per share, you can calculate cash flow per share or operating profit per share. In that context, remember that per-share measures are not always comparable because of the different number of common shares outstanding among firms. Okay, as we said earlier, users of financial statements normally compare an organization's EPS with that of competing companies, along with the way this metric changes over different accounting periods. How do we do that? We simply look it up. All public companies are required to report and publish their results. So if you would like to check on General Motors' earnings per share for the last year, for example, you just type GM EPS. The latest quarterly and annual results, along with relevant statistics, immediately pop up. You can see a summary of EPS figures for the last 5 years, along with an interactive chart presenting the same information, and a table format too, if that helps. Amazing. What else? The P/E ratio is another widely used valuation metric. It is often simply referred to as the price multiple. Investors typically use it to weigh various stock prices within the same industry against one another. The P/E ratio is calculated as the share price, the price at which shares are currently traded on the market, divided by the latest earnings per share, EPS. Calculations are pretty straightforward. If SalesSmart's current share price is $2.95 and its latest earnings per share, as we calculated earlier, is $1.77, then its P/E ratio will be 1.67. This means that for each share you buy, it will take you 1.67 years to generate $1.77 of earnings per share. Put differently, the P/E ratio indicates the price that investors are willing to pay per $1 of earnings generated. Okay. Please note that we can also use a slightly different formula. If we multiply both the numerator and denominator by the total number of shares outstanding, we get a company-wide P/E formula. In essence, we divide the total current market capitalization by the latest reported net income. Sometimes, analysts might prefer to compare market cap and net income figures rather than individual share prices and earnings per share. Thus, you eliminate the effect of size. The conclusions you draw for a 1 million and 100 million market caps would be different, right? Company-wide statistics normally account for better comparability. At the end of the day, whichever formula you decide to utilize, the PE result should be the same. Once again, we see that SalesSmart's price-earnings ratio is 1.67 and 1.54 in the current and prior year respectively. All right, great. All too often, you will come across a comparative analysis of price-earnings ratios of companies in the same industry. We have PE statistics for the banking sector, automobiles, computer services, electronics, household products. Wait, SalesSmart falls into this category. The average price-earnings ratio of similar companies in the United States is 25.49, whereas SalesSmart's PE indicator was 1.67. This shows that the firm's current share prices on the market are relatively lower than the industry average. Indeed, $2.95 per share is way below the stock prices of competing companies. Based on this information, we may expect that, all else being equal, SalesSmart's share price will keep up with the industry norms in the future. Besides, you can look up the latest price multiples of a particular company within a given sector. For example, this is how Procter & Gamble's price-earnings ratio evolved in the last decade. At the time of our analysis, P&G price multiple is 62.15. This type of analytics helps financiers determine where a firm stands as compared to its competitors. Why is this ratio so important to investors, you might ask? Because this is the simplest way to assess whether a stock is under or overvalued. And this underlies the effort and scope of any financial analyst out there. Put differently, the PE ratio represents the shareholder's point of view with respect to the future prospects of a company. We can even say that it is indicative of market expectations. In a sense, a higher than average price-earnings multiple may mean two things. Either current share price is too high, the stock is overvalued, or the earnings are too low. Normally, we assume that markets are efficient enough to adjust pricing anomalies rather quickly. Therefore, when we encounter high PE ratios, we should perceive it as an indication of currently low EPS and a rapid earnings growth being on the way. Correspondingly, the lower the PE ratio, the lower the likelihood of earnings buildup. So, if you are an investor following the market sentiment, you will certainly look for companies with high PE ratios. Yet, it might be the case that current share prices are currently below average, and a stock's price increase is expected. As you can see, financial analysis isn't always black and white. Terrific. When using price multiples, you should be aware of its limitations, though. As every fundamental analysis, we need to make sure that we are comparing apples to apples. Some industries, such as telecommunications or energy, are characterized by relatively high PE ratios, whereas manufacturing companies often exhibit low price multiples. It is a matter of how much investors are willing to pay for each dollar earned in a particular sector. Besides, within the same industry, firms have different capital structures. If the debt-equity ratio of company A is 70-30, while for B it's 10-90, then any price multiple comparisons would not be viable. So we should bear in mind that PE ratios are highly dependent on a firm's capital structure. What's more, analyzing the PE trends of one company may be of little value, especially when certain one-off events occur. If a firm goes through a major restructuring or acquisition, both share prices and earnings per share may take unexpected directions. In a nutshell, the price multiple is a very useful measure for analyzing stable firms. If you find a solid company that is growing at roughly the same rate, with roughly the same business prospects as in the past, but is trading at a lower PE than its long-term average, you should be interested. All right, great. Before we wrap up, let us quickly examine another valuation ratio, the dividend yield. It is calculated as the amount of dividend per share divided by the current market price per share. Okay, so what does it show us? Basically, it illustrates the proportion of a share's price that is distributed as dividends in relation to the amount reinvested in the company. Imagine the following situation. Investors buy some of SalesSmart's common stock for $3 per share. Would they be happy if they received a dividend of $2 per share? Most probably, yes. This sounds like a very good return on investment. However, such a high dividend yield means that the company would have limited funds to reinvest in its operations. Thus, future growth is also limited. That's why too high dividend yields are usually not sustainable. Conversely, the lower the dividend yield, the more the market is expecting growth in future dividends. Let's do the math. Looking at SalesSmart's financial information, dividend per share is $0.88 in the current year and $0.65 in the previous year. Its common share price is $2.95 and $2.15 respectively. This results in a constant dividend yield of 0.30 in both years. The constant dividend payout ratio policy, in which companies distribute a fixed percentage of total earnings to shareholders, is very common in practice. Amazing! To conclude, the key takeaway from this lesson is that valuation ratios measure the equity investment in a firm. They can hardly indicate operating efficiency or profitability in isolation. If a company is doing well, the value of its equity capital goes up and its valuation metrics improve. This is how you can quickly evaluate any public company.